Hi there, I'm Mark Sebastian, the founder of OptionPit.com, and this is Principles of Risk Management, the Option Pit Method. So let's just briefly talk about a couple important things. One, this is your standard disclaimer. This is meant for education. These are forward-looking statements and not meant to be predictive. You are responsible for the application and investment decisions, not us. If you lose money based on something we say, it is your fault. This is me. I'm Mark Sebastian, the founder. I've been a trader for almost 15 years now. I was a market maker on the floor of the Amex and the SIBO. I now run Option Pit, and I run a hedge fund called Carmen Line Capital. We are a volatility arbitrage fund. And that is me. So today we're going to talk about what is risk management. We're going to start, where to start. We're going to talk about the money plan, the portfolio plan, and the position plan, and then talk a little bit about a portfolio insurance. Risk management. The word you've entered is in the dictionary. Well, of course, because it's a two-word thing. That's why. But what is risk management? Well, my definition for risk management for option traders, and this is really kind of all risk management, is can you take the taking of risk in the most capital efficient manner as such to receive the highest possible reward for the fewest amount of dollars spent. That's really risk management. A lot of people think, well, it's adjusting. No, I mean, risk management starts with onset of the trade. All right. So how do you get going with risk management? And this is the part I always tell people is, before flying a plane, pilots go through extensive training. I mean, a year of training. And really, it's all classroom work. They're learning about how the wing works. They're learning about the aerodynamics of the plane, all sorts of stuff like that. Then the pilots must do extensive time in the simulator. Why? And this is why you need to do similar things, is that way when you're flying, you are prepared for what could happen and why it's happening. That is the key. All right, so where do you start? All right, and you start with understanding the instrument. Right? How is the future different than the equity? How is the option different than future? Learn the workings of that instrument intuitively. All right. Now, how many of you know what the underlying is for a VIX option? Yeah, VIX futures. There are people that don't know that trade VIX options anyway. Think about that. That's bad risk management. So with options, it starts with can you read the option quote? All right. How do options price? How do option synthetics function? This is everything you need to do before you can trade. All right. How does the pricing model work? How do the Greeks function as an output of the pricing model? And what are the non-modeled risks of options? Bing, bang, boom. If you can't do all of those, if you don't have a clear understanding of all 6 of these bullet points, you should not be trading options. All right, now, can people hear me? Can we hear me right now? That's weird. It says I've got an audio problem. That's weird. All right. Good. All right. As long as we're loud and clear. So why do you need to know theory? Why do you need to know theory? And the answer is that those pretty charts that you get from your brokerage are great, but they're built on models. If you don't understand how the model works, you can't manage risk. So it's annoying, but save the shortcuts for later. Understanding the cause of risk is understanding the key to management. And believe it or not, if you spend the time, a lot of people want to trade right away. If you spend the time to actually learn these bullet points, you will be profitable much faster than if you start trading right away. It will make a huge difference in how quickly you become profitable. All right, so understand the contract you are trading. What are the dollars at risk? What is the multiplier? What does it expire to, and when does it expire? Sounds easy, but it's not always. All right, let's talk about SPX. All right, we've all heard of the S&P 500. There are about 20 different ways to trade the S&P 500. You've got the S&P futures. You've got options on the futures. You've got SPY. You've got options on SPY. You've got SPX. You've got options on SPX. You've got mini SPX. You've got options on mini SPX. There is a lot of pieces in that pie. Now, once the trader is actually ready to trade, the next step is to build a money management plan. A money management plan will allow for how much of an account will be engaged in the market and how that money is allocated as it is engaged. So what kind of money do you have to work with? What is your goal rate of return? How can you allocate your capital so that you are able to achieve that rate of return? Can this be done without risk of blow-up? Is the plan efficient, and does the plan scale? Different accounts warrant different approaches to trading. Do not treat any capital lightly. I know people that treat capital, their trading money, lightly. They look at it as like arcade money. Or, you know how like people will put money into a casino machine and just blow through it. They don't even know what they're doing. All right. All capital is a part of building success and wealth. There's no such thing as throwaway capital. Treat every dollar as if it matters. Never say something like, oh, it's only $6,000. All right. So just always remember some things that cost $6,000 or $7,000. Here's a Camaro. Who wouldn't want that sweet silver Camaro? All right. Here's a set of daffodil, strass silver crystal, Christian Louboutin shoes. Who wouldn't want to spend this? Who wouldn't want to spend the $6,900 on these shoes rather than lose the money? So the key is be aware, be aware that all dollars matter. And then the next key is be realistic. I was on Twitter last week with somebody, and I want to pull this up. The guy was a nice guy, and we were going back and forth, and he was asking about some of our coursework, and he said that I'm just trying to create monthly positive cash flow on like a $5,000 to $10,000 account for $1,000 to $3,000 a month. All right, and I said, that's $1,000 a month would be on a $10,000 account would be 120% annual return. And the guy hadn't thought about it that way. He said, wow. I guess maybe that's a little unrealistic. A lot of people set unrealistic expectations. And that's because a lot of people are pitched that. There's a lot of scum out there that want to show you, oh yeah, you could make this or this or this. That just isn't the case. You can, but that's the 1% of the 1% of the 1%. So be aware of what is realistic. If you're trying to make 5% a month, compounded, you're talking 80%. Simple, you're still talking 60%. 2% compounded is 26%. In simple rates, that's 24. That's a ton of money. All right, I can tell you most funds would love to make 24% a year. So the key is be realistic. Having the right expectations will help the trader avoid making silly risk mistakes. All right, now, how much of an account, now allocating capital, how much of an account should stay in cash? Should always be cash in the account. What is the target rate of return on traded capital? So, I mean, think about this. You're looking to make 5% a month, and you want to stay 40% in cash. Well, now, on your traded capital, that 5% a month, you're really trying to go for what amounts to 10% a month. Right? And then what is the, what is the target return on traded capital to achieve the trader's goal rate of return? So ceteris paribus, how should capital be allocated into each trade to achieve the target rate of return? So if, I ran a capital allocation plan, if they all did about the same, how much would I make? And then allocate trading across trades. The next key to think about is the risk of blowup. No trade makes money every month. When allocating capital, one common mistake is the too much of a good thing approach. Right? Traders need to be diversified. This means be aware of the risks of long or short premium. At Option Pit, we hedge off every trade we do. All right, we hedge off every trade. Right. So take appropriate steps to ensure that one is always able to trade. And then never be net short contracts. Always have some extra contracts floating around, or at least be flat. All right. Anybody ever heard of Karen, the super trader? She gets floated out there like she's a hero. Yeah, she's not such a. She's Karen, the super con artist. Yeah, she was a fake. Yeah. Oh, yeah. She's the SEC. Yeah, the SEC is taking her down for fraud. She was a strangle trader, and if you hedge every trade, won't that make every trade more expensive? Yes, but it will smooth out your risk of trade, your risk. So what a lot of people don't realize is there's this concept of risk-adjusted return. And so those of you that, so you can think, hey, I'm going to go and try and make all this money, and then one day you blow up. Or you can take a risk-adjusted approach, and in that approach, what you end up having is you end up with a decent return and a relatively low standard deviation, right? So, and you are still leave yourself in a position to do extremely well. So let's look at our strategy. I had thought there was possibility of criminal, but I don't want to go super deep into that. But yeah, she's bad. All right, let's see what we got here. So these are all trades. So a normal trade, we'll do like a little call spread, and we'll be long one put. Or we'll do a bear VXX put spread, and we'll be long a call spread. UVXY, long some puts, long a call spread. So we set these trades up so that we have a lean, but if we're wrong, we at a minimum don't lose and probably win. Here's this SPX condor that's gone haywire, and this includes all trades. The condor is down $195, but guess what? We hedged it off, so it's actually up $30. So if you hedge off, then your losers won't lose as much, and your winners will win a lot. So year to date, we're up $9,000, and the account really only trades about $15,000. It's got all this extra cash in the account that we don't use. So we've done, obviously this doesn't include commission, but what we usually tell people is take off a third of your P&L, which we think is aggressive. So taking off a third, the strategy letter is up, what, $6,000 on the year, trading about $15,000. So that's 40%. That's not bad. No, we allow for some lean. We don't hedge off the entire risk, but we change we allow it so that if we're wrong, we can win. All right, so now evaluate the plan. This is something people don't do enough. Once the money management plan is in place, make sure to evaluate the plan after its completion. Is there too much concentration on one type of strategy? What is the net vega? All right. Does the strategy ever have long realized exposure? So if the market moves, is there stuff that will make money? If you've got a portfolio on that is completely short premium, you've got a problem. Eventually, we'll get a strong move. And then, is there enough insurance, or do you have an insurance plan? All right, if you take down a big, long realized vol position, you don't really need insurance. And I'll show you what our positions kind of end up looking like here in a little bit. All right, and part of the reason for this is the scalability. So this is where a lot of guys get flipped up. They'll see some broker show how they do this trade with a $10,000 account. And they go, oh, wow, I can retire on that, except for when they try and trade off $100,000, there's way too much risk, and they're unwilling to do it. Or there's a bunch of risk, and they get beat once, and then they don't trade it anymore. So many traders take far bigger risks with small accounts because they don't think about scale. Scalability is so important. All right, and then here, I'll show you kind of what our position looks like here in a second. All right, so now the trading plan, and this is the nitty-gritty of our capital allocation. It assumes all trades are in tradable but not spectacular condition, and then allocates capital across each trade. So basically it says that you're willing to do all of the kind of trades you like to do. They're all equal. And then you adjust the size according to market conditions. That's called conditional trading. Right? So we're not trying to fit a square peg in a round hole, or a round peg in a square hole. Right? And then you put into place restrictions on loss and target gain. And then it covers adjustment strategies and insurance, things like that. All right, and then finally, it adjusts allocation according to what trades are more or less favorable. If butterflies are statistically more favorable than time spreads, do more. If condors don't look good, don't trade them. Cash is also okay. And then as positions build, it also changes. All right, so now here is our method for trading. And this is why the strategy letter does well. The other reason why we are hedged is because we do counteracting trades. So on the floor, the trades come to the trader. All right. With each trade of one particular type, the trader needs more and more edge. So on a premium sale or a premium purchase, it's how, how much over underpriced the trade is. So with each trade that has more edge, the trader increases the size of the trade slightly. As the trade becomes more or less short premium, the trader is willing to accept less edge and to take the opposite trade. So if I'm long a lot of premium, I will sell premium at a discount. If I'm short a lot of premium, I will pay up to get long. And then you trade the Greeks to offset each other. All right, that is how market makers trade. So they sell more, then they sell more, then someone comes in to sell the trader something, and the trader buys a little, and then he buys a little more, and then he buys a little more. All right, and so a retail trader, you don't have the trades coming to you, but you do have an edge, and that is the ability to initiate the trade. All right. The ability to initiate the trade is huge. So every trade should have perceived edge in it. These options are too cheap, these options are too expensive. Things like that matter. And so each successive trade should be better than the last. All right? A trader that has a lot of short premium needs a lot of perceived edge to sell more. And you should ladder higher. So your first trade should be about a third to half the size of your final trade in that direction. And unlike a market maker, you need to cap your dollars. All right? So as a trader builds Greeks, he or she is actively looking for trade to take the other side. So if I'm long a lot of delta, I want to look for trades that will make me short delta, or trades that fit. Now, I don't try and force anything, but if I see a decent trade that gets me short delta, I'll do it. If I'm short a lot of Vega, I'm going to look for cheap straddles to buy. If I'm long a lot of Vega, I'm going to look for butterflies to sell. I'm going to look for iron butterflies to sell. I want to put on trades that take the opposite side of what I have on. So if executed properly, the trader should be able to carry a portfolio that has little systemic risk. All right. Am I willing to accept risk on a stock by stock or index by index basis? Yes. Right. But what gets a lot of people is they have a bunch of different condors and butterflies and spreads on, and then the market moves, the S&P tanks or the S&P rallies, and they fail to realize that their entire portfolio correlated to itself. All right. If you can limit the risk to kind of company and index and specific index risk and take out systemic risk, you will be profitable over time if you trade for edge. If you trade stuff that's overpriced, you sell stuff that's overpriced, buy stuff that's underpriced, and create offsetting positions, money will be created. So things to remember, you need to learn to capture edge, you learn how to weight Greeks, use capital weighted and beta weighted. All right. There can be a little commission in this, so you need to fight for low commission. It requires slightly more active management, but it is also something that can turn into a real job. You want to become a full-time professional trader. The method I just described is the quickest, most efficient way to do it. And it requires strong understanding of option fundamentals. Now, the most important thing to remember is that gamma and vega are the most important Greeks to monitor in any approach. All right, theta and delta handle themselves. So if you manage your gamma and you manage your vega, you will make money. And then be aware of how the Greeks change with underlying prices. A balanced portfolio can change on you. And then master VIX trading. If you haven't figured out how to trade VIX, then you're probably not ready to trade. And then I'll talk about managing the book here real briefly. But I want to show you kind of what our positions end up looking like. So I'll pull up just single index. So we'll do SPX. So if we were going to if we might do 2 trades in SPX, we might say, boy, December volatility on the 16th is too high. So maybe then we say, okay, what we're going to do is we're going to sell an iron butterfly or an iron condor. We're going to sell the 220 sure, the 220, 210, and then we'll sell the 280, 290. Standard iron condor, not a lot of Greeks to it, which is nice. And if I look at this in over the next 8 days, I'm not sure why this showed up as a butter. Oh, because there you go. There's my iron butterfly. And sounds great, right? Short some gamma, collecting some theta. So then maybe we go, oh, but as expensive as that is, I mean, look at kind of, you know, there's other Fed meetings come up. I could buy, you know, January a month out, more than a month out for about the same volatility. Seems cheap. What if I bought a couple 3 straddles or 2 straddles? Look at that. Now, that's a position that I can make money on. It's collecting premium. I might make money twice. But this is kind of what our net strategy ladder portfolio ends up looking like for the most part. If you were to group everything into one big pot, this is what our trades end up looking like. Actually, it's probably along a little too much vega. No, this is more of a condor. So if you want to look at what the trade is, I mean, you can see I've got the 80, 90, 2220, and then the 45, 50. So I'm in a position where all of these trades could win, but I'm unlikely to lose on all the trades. And they offset each other. And if we wake up tomorrow and the market is down or up 100 bucks, 100 points, do I win or do I lose? Right, that's how we trade. All right, so here's a little quiz. So I do a scale. I do a sale of an iron butterfly that I rate a 3 out of a 5. Then I do an iron condor that I rate a 3 out of 5. Then I do another iron butterfly that I rate a 4 out of 5. So now 2 trades come in. I can either buy a straddle that's rated a 3, or I can sell an iron butterfly that's rated a 4. What trade, if I'm using the option pit method, should I execute? Right. Buy the straddle. So the way I get long trades being smaller is that they don't have a capped risk. So I'm doing, you know, a condor, which is 2 spreads, versus which is a couple of spreads put together, and I'm doing 10 of those, versus, just 1 straddle, because straddles don't have. How do I rate the trades? This is where understanding what makes a good trade and a bad trade comes into handy. This is where going through our coursework on our individual products or going through gold and platinum makes a big difference. If you don't understand what makes a good trade from a bad trade, which really comes down to understanding the fundamentals of all of this, you're going to have problems. So in the end, our method states put on good trades for edge. As a portfolio takes on risk, look for trades to take the other side. Manage each trade on its own. Practice tight risk control. Manage portfolio Greeks. And, this is important, A, B, C. Always be closing. Always be closing. A, always, B, C, closing. Always be closing. Always be closing. What moving? The benefit of this is you will sleep at night like a baby. Yeah, Glengarry Gunloss is correct. Yes, and generally speaking, we are overall theta positive. Yep. All right. So you can sleep at night. The risk will be lower. Trade duration will be shorter. You'll likely be profitable, and you can be wrong a lot. So how does someone? So this is a good question. All right. So the trade plan. What is the most important part of managing the risk of a trade? Pick good trades. Good trades make risk management easy. How does one enter good trades? Take to understand the time to what are the best conditions for each trade, then build an adjustment plan. John, I will answer that at the end. Remind me again. All right. I don't know, Greg. That's a good question. Yeah, 50, probably more than 50. So, yeah, I don't know. I'd have to think about it, but you're trying, I'm really trying to make 1 or 2% a month. So, do the math there. But I'm going to win on some of my longs. All right, so now write up the optimal conditions for every trade. This is key. Write an adjustment plan for any potential conceived move. So you should have great conditions, normal conditions, and no trade conditions. Then write up an adjustment plan. So what happens if the underlying rallies and implied fall? And is falling. What happens if the underlying rallies and IB is up and rising? What happens if the underlying falls and IB is up but falling? There's all these conditions. Set a maximum loss for each trade, and then set an absolute max loss. And the absolute max loss is a level that a trade could never get, a level that something would never get to under a reasonable scenario. So for a condor, maximum loss might be the same as the target profit. Absolute max loss might be the total cash taken in. All right, so one of the hardest things for traders to do is when a trade is down but not a maximum loss, what do? So a lot of them won't adjust, so they'll stay in overnight. So if absolute max loss is within 1 standard deviation, the trader should adjust the trade regardless of the max loss. It will save you money. So now, the keys to adjusting. For every trade, there's likely some variation of adjustment that's going to work. However, there are some important keys to adjusting that will make sure you don't blow yourself up. All right? I see more blow-ups from bad adjusting than I do bad trades. So the rule is set max loss. When you're at 1/3 of max loss, make an adjustment. When you're at 2/3, make a second adjustment. When you're at max loss, kill the trade. The third rule. You can also do the half rule. So when you're at half max loss, make an adjustment, and then if you get there, 2 max loss, close. And now, a couple of adjusting rules. Never throw capital at a trade. The idea that simply adding a butterfly or calendar to a calendar or a butterfly is simply wrong. Rolling and increasing the size is also a mistake. Try to add as little capital to a trade as possible. When I see people blow up, it's because they throw money at the trade. All right? So try to add as little capital as possible. Keep return targets and maximum losses off of the original trade. Do not add in the capital from adjustment. Never open up a cheap option. Stay contract neutral. So the goal of an adjustment should be to add as little capital as possible. Generally speaking, when I adjust, I'm buying options on a short trade. On a long trade, if I'm on a short theta trade, I'm selling options to adjust. If I'm on a long theta trade, I'm buying options to adjust. That is the easier way, the safer way, and the better way to adjust. All right. So insurance. So traders can buy insurance. You don't have to. But I will say never be short those cheap options, and cover them when options get cheap. It is always worth it to buy back, even though it's statistically favorable to be short worthless options. It is always better to cover worthless options. That way you will be able to trade the next day. You always want to be able to trade the next day. You always want to be able to do more of what looks good. So in summary, there are a lot of keys to risk management. It starts with knowing what you're trading intuitively, and then it goes to building a plan. All right, now, we were originally going to do this on Saturday, but we've actually moved this to a week from Saturday. So Saturday the 17th, we're doing trading stocks and options with the Fed. Interest rates are rising for the first time, really, in 20 years. Many of you probably weren't trading options the last time interest rates were going up, myself included. But I know how options are going to act, and I've got some strategies to trade around interest rate volatility. In addition, Andrew, my number 2, was trading when interest rates were going up. So what are you going to learn? How interest rates, stocks, and options affect each other, what stock and option trades benefit from rising rates, simple and complex methods to take advantage of rising rates, how to trade the bond ETFs, how to trade equity index and ETFs with potential higher returns with rates up, strategies around rates for investing in long-term investors, and some risk management techniques. And here's the page you can go to, or you can go under our events page, optionkit.com/events. All right. So we got optionkit.com/events. So it's normally going to be $297 for the course. We're doing $147. All right, you can sign up here. Why did we move the webinar? We moved the webinar because I didn't realize that I set it up against taking my kids to Santa. I will be discussing a ton of option strategies. So sorry, family first. So we had my kids signed up for meeting Santa that morning, and I need to teach the webinar. My trading platform on Fidelity doesn't allow me to easily track Greeks. I told her, should I track it by hand or is it something else? I would dump Fidelity, yeah, there's other ways to track it. All right. So how does someone with a good paying day job handle this balancing? Well, one, I would say don't trade too much. So, we're talking 2, 3, 4 trades a week. And really, John, I think kids only trade trades that are great then. So yeah, the webinar is going to have some very, it's going to be almost 4 hours long with a break. All right. So that will be really good. That's going to be a great course. Please have some webinars on very basic option trading.